averted. U.S. dock workers have agreed to end a 3-day strike that paralyzed trade on the U.S. East and Gulf Coast and threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%. And people familiar with the matter are telling us that the European Union has voted to impose tariffs as high as 45% on electric vehicles from China. The results have not been made publicly available. The European Commission can now proceed with enforcing the duties. Sources telling Bloomberg that 10 members voted in favor. Germany and 4 others voted against, while 12 abstained. China has threatened its own tariffs on European dairy, brandy, pork, and cars. Alphabet's Waymo has announced that it will expand its fleet of robo-taxis with Hyundai's electric vehicles. According to a joint statement from the companies, Waymo's sensors and software will be built into iconic 5s in significant volumes at a new Hyundai plant in Georgia. On-road testing of the Hyundai EVs will start in late 2025. The two companies are also in talks for other opportunities outside of the EV supply agreement. And that's your Bloomberg Brief, John.
Shanali, thank you. Up next on the program, a trade crisis averted. We'll catch up with the National Economic Council Director, Lael Brainerd, in just a moment. That conversation up next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The open about 1 hour and 15 minutes away. Equity futures on the S&P 500 positive here by 0.25%. 8:30 Eastern time. The jobs report just around the corner. The number we're looking for, 150K. Under surveillance this morning, a trade crisis averted. U.S. dock workers ending a 3-day strike that temporarily halted East Coast trade. The union extending its contract through January 15th, allowing more time for negotiations and avoiding a contentious labor and economic battle just ahead of the election. Joining us now, I'm pleased to say, the National Economic Council Director, Lael Brainerd. Director Brainerd, thank you very much for giving your time to Bloomberg TV this morning. The first question we all have is how much progress have we actually made ahead of January 15th? You've been a big part of the conversation. Could you share some of that information with us?
There's tremendous progress. The most important thing, our ports are back open, our dock workers are back at work. American consumers really won't see any effect of this at all. And again, we see that the collective bargaining really works when you support it and give it a chance, which is what the Vice President, the President have always done. In terms of the progress at the bargaining table, for many months, the two parties hadn't been working together. Now they have extended the contract in order to really roll up their sleeves and address the remaining issues on the table, having now solved the wage piece of this. So good news for everyone, I think.
Some people would argue the remaining issue is the hardest issue. It's automation. And they're trying to work out whether this punt, if we can call it that, was about the election, just to push this out to January 15th, or whether it was about doing the patriotic thing and making sure that we could get the things we needed to get to the disaster zones across this country following the hurricane, from the ports and through this country efficiently and effectively. Can you share with us, Director Brainerd, what this was really all about?
Absolutely. So on the part of the carriers, the port operators, and the dock workers, you know, they all wanted to get back to work. I think it was a patriotic effort. We wanted to make sure that the hurricane supplies are moving and that consumers don't see any effects, as well as American farmers and exporters. So I think on all sides, there was a real desire to get to a solution that could carry them forward, get back to the negotiating table, get those ports open, get back to work.
Director Brainerd, what does the White House deem acceptable when it comes to the language on automation?
So we really don't take a position on how the collective bargaining process resolves. What we do care about is making sure that we support the collective bargaining process and allow the parties to come to conclusion that works for both sides. And that's the role we really played here, was bringing the two sides together, encouraging them to find something that they could agree on. And they did find agreement on wages and agreement on extending the contract to January 15th. So I think what we did was support the collective bargaining process, support the parties getting back to the table. The rest is really up to them.
You've done a lot of work, though, Director Brainerd, when you came into the West Wing on supply chain and supply chain resiliency. How does the White House weigh, given all your work, the fact that we could have more efficient ports? Is that more important, competing with China, these efficient ports, or union jobs?
So, of course, what is very important is to make sure that we are making all the improvements that we can to our supply chains. And as you know, we have massive investments now through the bipartisan infrastructure law in our ports. We also have a supply chain council at the cabinet level that I run on behalf of the president. So we have much more data across the supply chain. There is a flow office now at the Department of Transportation that helps all the participants, the carriers, the operators, the retailers, the farmers, have the data they need to plan ahead and to mitigate. And that process was on display in the wake of the Baltimore Bridge collapse, and it was on display in the weeks leading up to this successful extension of the contract and resolution of the wage issues.
Do you think there's a chance that we can get to the automative language of this before January 15th?
I think that the carriers, the operators, and the dock workers know they have work to do to find an acceptable outcome on that and many other issues. But I have a lot of optimism now that they're talking to each other, that they really made a good faith effort on the wage piece, and that moved these negotiations forward again. You know, they had not been speaking to each other for months, and our interest was really getting the two parties back to the bargaining table on the basis of a fair wage. Don't forget, these dock workers, in the previous 6-year contract, some years they got no wage increases at all. Other years they got $1. Meanwhile, we had COVID. We had dock workers really risking their lives to keep goods moving on behalf of American consumers and businesses. And the port and carriers really during this last few years had record profits. And this is a deal that could give workers their fair share after a period of having very little wage gains. So it's a nice, important step forward. Of course, they have more work to do.
Director Brainard, I can say I'm really impressed in your ability to focus with them mowing the lawn and yelling behind you, because honestly, it's always sort of unfathomable. They're always mowing the lawn there. So thank you for that. I am wondering, though, Director Brainard, how much you see a sort of necessity for workers to have to be kind of flexible at a time of great change, and that there are some technological changes that are more easily implemented if companies have the ability to figure it out as they go along, to not necessarily be beholden to contracts that were written in a different time. How do you argue that labor negotiations should continue with organized labor if companies need to have that suppleness at a time of great change?
Yeah, so what I would say is when you look at the contract that you saw on the West Coast ports, for instance, which was a very successful contract for workers, for all of the employers. It is a contract that resolves those issues and moves forward. And I expect the same is possible in the context of the collective bargaining process that now has been extended into next year on the basis of a really strong wage offer. You know, unions are more popular than they have been in decades. And I think the president, the vice president are demonstrating by their actions, this is how we enable the collective bargaining process to work. And the collective bargaining process does reach fair wages for workers, and also a set of other really important agreements about how workers should have voice in the way the business is organized. All of those things are on the table, and we believe that we have just enabled that collective bargaining process to continue in a very productive way that's good for everyone. Most importantly, getting the ports back open so we can get those supplies to areas affected by Hurricane Helene.
Lisa is getting to a much broader and more philosophical point, though, Director Brainard, that perhaps we can finish on. We are all vulnerable to automation. It is somewhat easier to be so pro-union when union membership is so low. If it was a whole lot higher, it would be far more disruptive. We'd all be complaining about being vulnerable to automation. How do you suggest that the American public should deal with the increase of use in AI and automation over the next several years? Should we all just go on strike?
Yeah, so what's very interesting there is unions have actually worked with the organizations representing employers on AI provisions. One of the first contracts to directly address artificial intelligence was, of course, the writers' contract, a really great contract, which had language that used AI as an enabler to enable writers to actually be productive, but kept the creative direction in the hands of humans. And of course, I think those are the kinds of principles that we have supported here at the White House. You know, we've released principles. It's just important for workers to be enabled, not displaced. It's important for workers to be sitting alongside businesses in making sure they work together on where AI should be used.
A much longer conversation for another time. We appreciate your time. I know you can't talk about the payrolls report. It's still to come. Director Brainard, thank you for your time. Your payrolls report is up next. 150K is the estimate. It's 4 minutes away.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is it. It's why we get out of bed in the morning. As we always say on a Payrolls Friday morning, good morning to you. It's 20 seconds away. Equity futures right now up 1/3% on the S&P, up 0.4 on the Nasdaq 100. On a Russell, up by 6. In the bond market, your scores, 2-year, 10-year, 30-year. Yields bleeding just a little bit higher, up 2 basis points on a 10-year, 386.49. The jobs report, the estimate in our survey, 150,000 with the print. Here's Mike McKee. Good morning, Mike.
Worth getting out of bed this morning, John. Look at this. 254,000 jobs were created in the month of September, the BLS says. The month of August revised up to 159,000 from 142,000. Remember, we had been talking about how we were seeing all the revisions go the other way. The unemployment rate falls to 4.1%. Call Stephen Stanley at Santander. He nailed that. He said that could happen. Average hourly earnings up 0.4 on the month, which is a surprise because this was a short month. The estimate was for 0.3. Average hourly earnings up 4%. So the labor union people got to be happy with this because they're getting paid more. 34.2 is the average work week. That goes down a tick. So something for them to be unhappy about. But the change in manufacturing payrolls down 7,000. Change in private payrolls 223,000, and that is certainly much higher than we saw from ADP on Wednesday. So on overall, a really strong payrolls report, which is not what anybody was really expecting. People thought maybe in some categories, but this is overall just really, really strong. And it'll raise questions about whether we're going to have an inflationary issue.
Yeah, just a few. Mike McKee, there'll be some other people shouting at the screen right now, hike interest rates following a jobs report like that. I'm joking. Some people might say it, though. Looking at this report, a monster upside surprise, and this is what it looks like in the equity markets. So far, good news is good news. We're up by 0.4% on the S&P 500. As we always say, we'll see if this sticks. We're up by 0.6 on the Nasdaq. On a Russell, we're up by almost 1 full percentage point. Push this story through the bond market. As you might expect, a 2-year, 10-year, 30-year that looks like this. We're higher by almost 15 basis points on a 2-year yield, 385.52. On a 10-year, we're up by 10 basis points at 394.78. And once you've seen a move like that, you know what foreign exchange looks like. It looks like this for the euro against the dollar. A break of 110. Never mind 111. We're down to 109.76 on euro dollar. Mike McKee, that is a monster upside surprise. You've had an extra minute to take another look. What jumps out for you?
Well, here's the amazing thing is we were within 0.2% of getting a 4% unemployment rate. When you go out to 3 decimals, it was 4.051, down from 4.221. So that's a major move, and it does suggest that the labor market is a lot stronger than we anticipated. The level change in the labor force wasn't that big, 150,000, but employment in the household survey up by 430,000, while unemployment fell 281,000. So a really strong household survey produces an unemployment rate of 4.1% that is, for all intents and purposes, interchangeable with 4%.
I'm so glad that John went through it because I was just completely in shock, sitting here with my mouth open, trying to figure out how people could have gotten it so wrong. This was basically the report that nobody was expecting, even the most optimistic and bullish members on Wall Street. What could be accounting for how wrong people understood this to be? And the fact that every single person who we talked to who's looking at the underbelly of the employment market says there's stasis, there's churn, people aren't hiring.
But
how do we understand
this? This is going to raise a lot of questions about where did all this growth come from and how did it slip under the radar. Now, a shout out to the folks at Bloomberg Economics who did produce a preview piece that noted that the home base data, which is a weekly report on hiring, had suggested a very strong employment report. And that, I guess, people put that aside and looked at both what's been happening in recent months and the QCEW revisions that we got, and just the commentary that people aren't hiring, and they adjusted their formulas that way. But this is certainly higher than anybody anticipated. 220 was the high for us, and Wall Street was looking at a whisper number of 151. So you can see why there's some straight lines on those graphs right there.
Mike, Luke Hawa on Twitter goes, and that's what happens when the Fed cuts 50 basis points, folks. So what does this mean for the Fed? I mean, 50 clearly off the table, but potentially, could this mean no cut?
No, I think, and I would have said this going into this, this is not the most important jobs report since the last one, because we have one more before the next Fed meeting.
It's always until the next one.
And now with the port strike over, that one should be much cleaner. We still have the Boeing folks on strike. Maybe the administration can settle that one too. We know there will be an impact from the hurricane. Hurricane Francine hit during the reference week for September, but the BLS says there was no impact from the hurricane on the data. But there will be an impact from the Helene. And so we'll be able to look through that. But that one will really set the tone for the Fed, because if we're going to see 2 months of strength, then yeah, maybe they back off and wait a month, wait a meeting.
Mike McKee's going to stick with us. Let's go through this again. If you are just joining us, welcome to the program. Monster upside surprise, 254. We were looking for 150. As Lisa suggested, the range was pretty wide, but nowhere near this. 220 was the high over at Jefferies. The low was 70 over at Citi. The number's 254. It's not just that. The revisions are positive. Wage growth is solid. And unemployment got very close to 4.0%. We're back to 4.1. Once you put all that together, look at the equity market picture. Equities up by 0.5%. The Russell up by more than 1 full percentage point. Check out the bond market. Front end of the yield curve. Yields up and away. Already a big week for high yields at the front end of the curve. We had another 17 basis points to that move, 387.39. And in foreign exchange, a much stronger US dollar against the euro. Euro dollar breaking 110. It's 109.70. With us around the table is Stephanie Roth of Wolf Research. Stephanie, you said the sky isn't falling. It's better than that. What is this?
It's a solid print. The 3-month average is now 186. Previously, if you were to rewind a month ago, the 3-month average was 116. We were looking for positive revisions because August historically tends to get revised up, but it got revised up and even more. So it's a labor market that looks okay. And to your point, probably 50 basis points is off the table for the next meeting.
But does this raise the question that we are systematically underestimating how much strength there is in the U.S. economy and, frankly, where the neutral rate is? Because that's where the conversation is going to go next.
That's certainly where the bond market's going to be taking it, that's for sure. Yeah, I think that's fair. And 3% consumer spending is probably going to be matched by a labor market that's doing okay and not kind of deteriorating in a big way, which is what we learned today, right? It didn't make sense before when we were sitting here with real consumer spending running around 3, even above 3%, with concerns around the labor market. Those things just don't go hand in hand. So yeah, we're sitting here with an economy that's running pretty solidly above trend. Labor market's doing just fine. It's probably unlikely we'll get another 50 basis point cut. The economy's kind of doing okay. It makes sense for the Fed to be cutting, right? 5% interest rates is too high for this economy, but you know they can go at a slower pace.
It's worth noting that a month is a long, long time. There's always a risk of extrapolating out these numbers this morning through the future. November 7th, we could be waking up on November 7th, the morning of the next Fed meeting, with no outcome of the election. As Mike McKee suggested, some real hurricane damage in many states across this country. Much weakness is going to come up. I've got no idea what the number looks like on November 1, just as I had no idea it would look like this on October 4th.
So it's very difficult to come up with a real sort of portfolio of data. The thing that stands out to me is that this is across the board. Every single data point that we have gotten until now, you could find something for the doves, you could find something for the hawks. If you're a dove, good luck finding something this. I'm sorry, Andrew Hollenhorst, not a great day, but this is sort of a question here of how much you're looking at an economy where suddenly the revisions are going in the opposite direction.
This is hard this morning. This feels like a big outlier, though, compared to the data we've had this week, particularly when you look at things like job openings, when you look at what's happening with hiring, when you look at what's happening with the quits rate. That number didn't scream a market that looks like the one we've just seen this morning.
Which is the reason why you're going to get a lot of people talking about what exactly happened here in terms of the actual data collection and how messy it is, given the fact that we have had so many questions around that. And I'm sure those questions aren't going away today as we see the two-year yield rise some 16 basis points and then some, with everybody just absolutely reversing trades that have been put on recently.
Let's get to the market view. Jeff Rosenberg of BlackRock with us, Mohammed Al-Erin of Queen's College, Cambridge with us as well. Jeff, I want to come to you first. Your thoughts on this, and as a market participant, what do I do with this?
Yeah, I mean, clearly, as was just described, this is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average. Across the earnings and the household survey, this is a very strong report. As was mentioned before, the revisions in terms of August was kind of expected. The home-based data and the alternative data, you had some people looking at that as well. Maybe not to the extent Bloomberg and Anna Long did and emphasizing it, but you certainly saw some data points that were pointing towards the potential here for a stronger report. But this is stronger than anyone expected. And as Lisa said, and I think this will be the longer run debate, and it's something we've talked about on this program a lot, the debate about not only where kind of policy is, how restrictive it really is, where R-star and neutral stands, but something else that has really been missing from this Fed's conversation that was present in past cycles. They've abandoned it, and that is the impact of financial conditions. Financial conditions say that this is a much easier monetary policy, and you look at where growth is, and it's kind of it's a concurrent signal, but growth is running well above potential, and that really tells you that this is not as tight of a Fed as the market, or really as the Fed thinks it is. Today is maybe another data point kind of in support of that view.
Mark Rowan, Apollo, earlier this week, financing is available. Real estate prices are going up. It's not clear we need more rate cuts. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day. Mohammed, I want your early views on this jobs report, and what on earth does the Fed do with this one?
So thanks, John. 4 takeaways, including for the Fed. One, on the labor market. This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle. 2, for the economy, it speaks to U.S. economic exceptionalism, something we've seen and something that's continuing. 3, for the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate. And finally, for the markets, I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. I think this will get the market closer to what's likely, and then we're going to have a debate on 2 things. One is, where's the neutral rate? And 2 is, how do you think about this economy in terms of growth and employment, and how are these 2 things coming together? So, at face value, this is a report that will cause a lot of revision, both in analysis and in market pricing. But I stress it is part of a much bigger picture of mixed data. And that's where the complications arise, John, as you know.
Mohammed, Emery nailed it when she started saying, how much does this have to do with the 50 basis point rate cut? And it's somewhat tongue-in-cheek, of course, but at the same time, there is a real question. How much have the easier financial conditions that have basically been manufactured by this Federal Reserve helped boost a market that wasn't maybe in need of such a big boost?
Look, you know my view. We've been living in a world of liquidity dominance. It has been all about liquidity. That world was reinforced by a 50 basis points cut. Let's also remember that the market didn't expect a 50 basis point cut based on data. It expected it based on a reporting on the Thursday before the Fed board meeting. So there was no economic conditions that would justify 50 basis points, but there was a leak to a newspaper that moved market expectations. I worry that we continue to feed this monster of liquidity dominance, and at some point we may regret it, either because inflation will not settle at 2% and or because financial instability will result from excessive risk-taking.
Mohammed, is there a chance that we can have a no-landing scenario?
Sure, there's a chance that we can have a world in which there are positive things happening on the supply side, and we can be, quote, bigger but not hotter. Yes, that is part of the distribution of potential outcome. I think a soft landing is still the 55% probability. Bigger but not hotter is 15%. So add them two up, you get 70, and then you have a 30% probability that either because or because of weakness in low-income households or because of a Fed policy mistake, we end up in a recession.
Looking at these numbers, and Mohammed, thanks for being with us. You're going to stick with us. If you are just joining us, welcome. It's about 8:45 Eastern Time this morning here in New York, and about 15 minutes ago, we got a blowout jobs report, 254,000. The median estimate in our survey was 150. Lisa's talked about the revisions repeatedly. The revisions were good. They were positive. If you look at the unemployment rate, we've dropped back to 4.1% from 4.2. Mike McKee suggesting we came very, very close to dropping to 4.0. Wage growth was hot as well. A lot of this was very unexpected. We've said it repeatedly through this morning. The range of estimates stretching from anywhere between 70 at the low side and 220 at the high end. Nowhere near this one at 254. Off the back of this report, equities are positive on the S&P 500 by 0.7%. On the NASDAQ 100 up by close to 1 percentage point. On the Russell, we're up by 1.5. With us around the table, Stephanie Roth of Wolf Research. Stephanie, I want to throw this one at you. There will be a lot of people in this country that don't believe these numbers. They will look at them, and some will say sarcastically, snarkily, they will say, if you're the Harris campaign, you couldn't have written this jobs report any better even if you wanted to. There are others who look at this, perhaps a little bit more sophisticatedly, and say that even the chairman himself is mentally marking these numbers down by, let's say, 50 or 60,000. Should we be doing the same thing this morning?
I think that's fair. And if it was a weak report, that would have been the initial thing of, okay, well, now if you subtract out the 68,000 that we got from annual revisions last year, now we're in trouble. The initial reaction to this jobs print isn't necessarily that, but it should be. So perhaps the conclusion shouldn't be the economy's on fire or there's no landing. It's probably that we're actually hitting the soft landing. If you take a straight 3-month average, you're at a little above 186,000. Then if you subtract the QCEW, then you're at a trend that's kind of normal. So I think the market reaction is probably going to be a bit extreme on the back of this. We should probably look through it. Last night the concern was we're headed for a recession. Now the concern is no landing. It's probably somewhere in between.
Jeff Rosenberg is good news. Good news.
Good news is good news here, and I think the key, going back to what Mohammed said, is the market had been very aggressive in terms of its pricing for the Fed. Partly maybe that pushed them into the 50. You had more than 225s for the November and December priced in. That's obviously pricing out here. And, next week when we get the CPI number, you may have, as Mohammed was suggesting, more of a debate as opposed to a one-sided debate where we shifted completely away from inflation as the focus back to growth. Having a little bit more balance here is going to make the outlook a little bit more challenging. And I think for the bond market, it's going to have to reassess its pricing in terms of how aggressive it has been pricing, as Mohammed pointed out, very aggressive from the get-go here in terms of expecting, the most extreme in terms of what the Fed was going to be able to deliver. Hard to say whether next week you get that surprise. I don't think we're talking about here inflation going back up and an inflation scare. That's not the point. The point about no landing is that the last mile from 2.6% inflation down to 2% may be harder to achieve. And why it's harder to achieve is because growth and financial conditions are not as tight as the nominal rate suggests. And so you don't have to necessarily be as aggressive on securing the soft landing because the inflation side is pushing back. That's what you're seeing here this morning in terms of pricing. It makes the front end here a bit more rational in terms of pricing in less than 250s to the end of the year, and I think that's starting to be more of the story pricing out of the bond market.
Jeff, how offsides is this market? And we saw this being sort of sniffed out earlier this week, this idea that people were thinking, wait a second, maybe we overplayed just how many rate cuts there would be, just what kind of dollar weakness there would be. How much does that trade, the steepening curve, all have to unwind as people reassess with this data?
Yeah, and as you pointed out, it started earlier this week. You've had some better data. The labor market data hasn't been as one-sided in terms of the fears, in terms of negativity. There's still a preponderance of the steepener view because when you're in a Fed cutting cycle, and we're in the beginning of the Fed cutting cycle, it's about how fast and how front-loaded it's going to be. It's also about the terminal rate and where it ends up. But generally, when you're in that time period, the steepener market reaction is what you're going to get, and you're starting from a very flat point of the curve. The problem for the steepener trade is timing. You need the pace of steepening to overcome the negative cost of carry, and fast levered players don't have a lot of patience for that negative carry. And so that can, as we're potentially seeing this morning, kind of exacerbate the moves on the headline. You know, going back to the birth-death model and what Bloomberg Economics has been highlighting, yes, this may be overstated in terms of the headline impact, and therefore may be overstated in terms of the impact of the market move. But the overall message here is that this is still a normalizing labor market, but not necessarily normalizing to the point where the Fed has to deliver consistent 50s to secure that soft landing.
Mohammed, one thing that you've talked about is that this is an overly data-dependent and data point-dependent Federal Reserve. It seems like everyone expects this Fed to still cut at least 25 basis points. Do you think that they have moved to a framework that is less data-dependent if the data actually suggests that the labor market is doing just fine?
Yes, I think they're moving that way. It started with Chairman Powell's Jackson Hole speech. It continued in his press conference. And I think they are moving away from being overly data dependent to also trying to have a forward-looking view of where the economy is going to settle.
Mohammed, does next week's CPI report matter to you at all now?
It matters to me, Anne-Marie, and the one that's going to matter even more is the one after that. Yes, it does matter to me. I think Jeff is absolutely right. This notion that the last mile was going to be easy, this notion that inflation is dead, this notion that we are mission accomplished, came way too early. And I think we're going to see from core inflation why certain parts remain sticky. Meanwhile, headline inflation is going to start moving up after not this month, but the next month. So yes, these CPI prints still matter. And of course, they matter a great deal to the American people.
Mohammed, talk to me about what kind of numbers you think we have to get accustomed with. Are we talking about stabilizing at these levels for inflation, or are we talking about the real risk of reacceleration, given what's happening in the commodity market, what we've seen out of China, and the easing that's come from the Federal Reserve, that after a jobs report like this, some people are thinking has come prematurely? How real is that reacceleration risk for inflation?
So to the extent we have an equilibrium rate of inflation, for today's economy, it would be 2.5% to 3%. If the Fed had the option, which it does not, if the Fed had the option to set a new inflation target, that is where it would make sense. We will settle, I suspect, somewhere towards the upper end of that because, as Jeff said, financial conditions are extremely loose. There are two factories of credit, two factories of liquidity. You heard it in the interview with Mark Rowan. There is not just the official factory, which has produced a ton of this, but there's the private factory that's getting more and more efficient and producing more and more credit and leverage and looser conditions. And we are living in a world where these two factories are still operating at quite a high level. So there is a risk, John, that we'll settle towards the higher end of that 2.5% to 3%.
Stephanie, I'm struck by the fact that given this report, we've all been thinking about organized labor working on the dock worker strike, with the Boeing strike as being sort of at the end of labor having the leverage. Is that a wrong way to look at this, especially given the fact that wages went up? Is it actually that employees have still the upper hand when it comes to demanding work and demanding to be paid.
I don't think that's an entirely fair way to look at it, in the sense that if you look at ECI for union versus non-union workers, there's a clear lag from union to from non-union to union, in that you get a big acceleration in non-union wages, and then unions tend to follow. I think this is really just a catch-up, but a catch-up from a really big acceleration in wages. So this is kind of a lagging indicator. The wage number, yes, it was 0.4, but it was, if you look at the three digits, it was 0.369. So yeah, it was strong, but it, you know, if you look at an average pace, you're still running a little bit below 4%, in which case it's not really concerning.
Final question for you all, and I'm going to say it up front so you all don't have to, and you can answer with just one word. There's a lot that can still change in the next month, but as things stand, your best guess for November 7th for this Federal Reserve, and these are the choices: 50, 25, or no cut at all. First to you, Jeff Rosenberg.
I'm going to go with 25, gentlemen.
Mohammed?
25.
Stephanie?
25.
Let's see how much changes in the next month or so.
Yeah, exactly, where the potential pressure becomes one way or another. It seems hard to see that they're going to go 50, given this kind of data.
Absolutely can't go 50. I think everyone's jaws. Fantastic payrolls report ahead of the election. This is going to do a lot for the Harris campaign.
Mike McKee, final word?
Chiefs? Oh, no, this is not the NFL. You're looking for... So a couple of things that came up here that I think are really interesting is people were thinking that the numbers might be boosted by the birth-death model, which people have blamed for the QCEW revisions, while birth-death models subtracted 128,000 jobs from this month's total payroll. So that's interesting. Steve Stanley, I mentioned him earlier from Santander, also was looking at the impact of college students going back to work who had been working in the summer. That drops them out of the labor force, and their unemployment rate fell from 7.8% to 7%. So that may have some of the impact here on the unemployment rate.
Mike McKee, enjoyed this morning. Thank you, sir. Just a blowout jobs report. Stephanie Roth of Wolf Research, Jeff Rosenberg of BlackRock, Mohammed Al-Erin of Queen's College came action going into the opening bell, up by 0.8% on the S&P, massive outperformance on a Russell. Your day ahead and your week ahead looks a little something like this. Bloomberg catching up with the Chicago Fed President Goolsbee at 10 a.m. Eastern on Monday. More Fed speak from Kashkari, Bostic, and Muslim. Tuesday, we'll get to the trade balance. On Wednesday, Fed minutes. Thursday, CPI, and another round of jobless claims, and some Delta earnings. And on Friday, PPI, UMich sentiment, and a ton of bank earnings.